Okay, let's get right into this explainer. We're going to shift gears today away from all that anxious, everyday noise about exactly which stock you should buy, and instead focus on the mathematical certainty of how you actually build and protect wealth. So we're looking way past conventional wisdom today and going straight to the data. We're going to examine the rules you've been taught, the invisible illusions that are quietly costing you money, and, well, the cold, hard reality of how wealth is genuinely engineered. To see just how counterintuitive financial math can be, think about this for a second. Let's contrast two different people. First, you have an early saver who put money away for just 10 years, invested 60 grand, and then completely stopped. Done. Then you have a late saver who started right after that first guy quit. This person invested for 30 straight years and put in 3 times as much money, $180,000. But fast forward decades later, and guess what? The early saver wins by over $250,000. Crazy, right? It's because compounding doesn't move in straight lines, it moves in curves. That early saver gave his money the one thing it needs absolutely the most: time. Because time compounds so much harder than money does. All right, that brings us to section 1, the illusion of timing. Basically, why taking action beats trying to predict the future every single time. To show you what I mean, picture two investors. Let's call them Wendy and Bridget. Now, Wendy hates the idea of buying at the top, so she stubbornly sits in cash just waiting for a nice, safe 10% market dip. But then you have Bridget, who honestly has terrible luck and ends up investing her money immediately at absolute all-time highs. Well, history tells us a pretty surprising story here. Bridget actually outperforms Wendy. Why? Because while Wendy is sitting safely on the sidelines waiting for a crash, she's entirely missing out on years of compounding, reinvested dividends, and time in the market. Plus, all-time highs don't just happen in isolation. They actually tend to cluster together in long stretches. And here is the really crucial point. Missing just the 10 best days in a 20-year period cuts your total returns by more than half. Missing the 20 best days, that reduces your returns by over 70%. And the absolute kicker here is that those best days notoriously cluster right after major crashes, usually during periods of peak fear. So by sitting on the sidelines just to avoid the pain of a dip, you are mathematically guaranteeing that you'll miss the explosive recoveries that actually build your wealth. And it turns out, the reality of picking individual stocks is just as wild. If you look at nearly a century of data, it shows that a mere 4% of stocks drive literally all market wealth creation. The other 96%? As a massive group, they perform about as well as super safe government treasury bills. This is exactly why simple, boring index funds consistently beat out those expensive hand-picked hedge funds. An index fund guarantees you own that magical 4% of winners, rather than you having to rely on the statistical improbability of finding them yourself. Okay, moving right along to section 2, the optimal wealth sequence. This is all about putting order over instinct. If we want to build wealth efficiently, we have to follow a specific financial ladder, step by step. And establishing a small starter emergency fund of about $1,000 has to happen first. This is your absolute firewall. It prevents you from being forced to liquidate your investments at a major loss or paying massive tax penalties just because, your car breaks down or your roof springs a leak. You have to protect the foundation first. Step 2 on that ladder is capturing your employer match. By taking full advantage of this before doing almost anything else, you are locking in the single highest returning, zero-risk investment you will ever have access to. Think about it. If your employer matches 50 cents on the dollar, that is an immediate 50% return before the market even opens. I mean, no stock, real estate, or crypto asset is ever going to give you that kind of guaranteed return. It's basically free money. Now, moving down the sequence to retirement accounts, let's compare two strategies. Let's look at Maya and James. Maya uses a traditional 401k, and unfortunately, she suffers from what we call tax illusion. Her balance looks huge today, sure, but she actually owes future taxes on every single dollar she withdraws later. Plus, she faces forced withdrawals when she gets older. James, on the other hand, uses a Roth IRA, so he paid his taxes up front. His balance might look a bit smaller today on paper, but every single cent in that account is entirely his to keep, tax-free, with absolutely no forced distributions. Which brings us to the ultimate question behind making that choice. What do you actually believe will happen to tax rates over the next 30 years? Well, given that the U.S. national debt is currently sitting over $35 trillion, and the interest payments on that debt are staggering, history strongly suggests that this kind of structural fiscal pressure leads to rising taxes. So, choosing a Roth IRA is essentially paying taxes now to buy absolute immunity from the very high probability of rising tax rates in your future. So, let's shift gears to Section 3, the real housing math. We are peeling back the layers of the old 28% rule. You've probably heard that rule, right? That you should spend 28% of your gross income on housing. But when we actually break down the math for, say, a $280,000 home today, principal and interest is just the starting line. When we add in all those invisible costs, property taxes, homeowners insurance, PMI, and just a really conservative maintenance reserve, that so-called affordable mortgage suddenly balloons. For someone making 80 grand a year, this total housing cost suddenly consumes a staggering 54% of their actual net take-home pay. And this creates what is widely known as the debt-to-income trap. Look, a bank will happily approve you for a massive mortgage based purely on your gross income ratio. But you have to remember, the bank's mathematical model does not include your grocery bills, or your childcare costs, or your car insurance, or that inevitable broken furnace. Getting approved for a massive mortgage and actually being able to afford it without totally suffocating your lifestyle are two completely different mathematical realities. Finally, let's dive into Section 4, the laws of survival. This is all about how you protect your downside. Let's start with leverage. It honestly sounds like a brilliant magic trick, using the bank's money to multiply your gains on a house or even in the stock market. But that amplifier? It runs in both directions, because leverage is tied strictly to your collateral. A mere 10% dip on a house that you bought with 10% down mathematically erases 100% of your equity. Let that sink in. You don't just lose a little, you lose everything you put in. And this brutal math is exactly why avoiding zero is the absolute ultimate rule of investing. The math of loss curves steeply against you. Think about it. If you lose 50% of your money, you don't just need a 50% gain to recover. You need a 100% gain. And if you lose 90%, you need an astronomical 900% return just to get back to the starting line. The whole grows so much faster than the loss, which means the size of your bet matters way more than the quality of your bet. You literally can't afford to let a single bad spin wipe you out. Looking back at the historical manias of 1929, 1999, and 2006, the pattern is identical every single time. As the saying goes, financial ruin doesn't just hit wild gamblers. It actually hits ordinary people who mistake skyrocketing prices for proof of actual underlying value. It hits people who start believing that just because everyone else is buying in, the math must make sense. But listen closely, price and value are not the same thing. To really understand the systemic risk beneath those kinds of manias, we have to look under the hood at the global bond market. Because the absolute unbreakable law of bonds is this. As interest rates go up, the price of existing bonds must fall. It's a seesaw. When interest rates spiked recently, trillions of dollars of old, low-interest bonds plummeted in value, completely shifting the ground underneath the entire global banking system. And that perfectly brings us to the ultimate warning light on the economic dashboard, the yield curve inversion. Normally, locking your money up for 10 years pays you more than locking it up for 3 months. Right? That makes sense. But when investors panic about the near future, they rush to long-term safety, pushing long-term yields down while short-term rates stay high. This specific phenomenon, this inversion, has predicted almost every single U.S. recession since 1955. It is literally the bond market screaming that something is wrong. And a big part of what's wrong right now is the staggering math behind our national debt. With higher interest rates resetting old debt, the U.S. government is projected to spend over $1 trillion per year just to service the interest on its debt. Let me repeat that, not to pay down the principal, just to cover the interest. $1 trillion. This changes the global financial landscape entirely, pushing borrowing costs higher for absolutely everyone, from massive corporations down to a family applying for a simple mortgage. So as we wrap up this explainer, I want to leave you with a question. As you navigate all these hidden mathematical laws of wealth, from the magic of compounding and tax illusion to the harsh realities of housing and the absolute necessity of surviving the downside, take a really hard look at your own decisions. Ask yourself what is actually guiding them. Are you doing the math based on real evidence, or are you just looking at a crowd? Because at the end of the day, only one of those is going to set you free. Thanks so much for joining me, and I hope you leave today feeling empowered to make the numbers work for you.